Hey, welcome to Channel S Quick Invest. Last time, we talked about the incredible rebound of Singapore's bank stocks after the COVID-19 crash. DBS, for example, saw its price soar after a significant dip, rewarding investors who had the patience to hold on. We also introduced the idea of a tiered buying strategy for those of you waiting to deploy your money. But now, the question on everyone's mind is, with an interest rate cut on the horizon, is it really a good time to buy? What if the economy faces a bigger threat than just lower rates? Section 1. The interest rate cut scenario. Let's first look at the most likely scenario, the expected rate cut. Analysts are predicting either a 25 or 50 basis point cut. The impact: when interest rates fall, it squeezes a bank's net interest margin, or NIM. This is the core profit a bank makes from lending money. A lower NIM means less profit for the bank, which can lead to a drop in its stock price. The market reaction: the stock market is forward-looking. A smaller cut might be largely priced in, leading to a minor dip. A larger-than-expected cut could cause a sharper sell-off, but it's likely to be a short-term reaction. This is why our tiered strategy is so important. You're not trying to perfectly time the bottom. You're planning for multiple possible entry points. Section 2. The stagflation threat. But what if the economy runs into a bigger problem? The elephant in the room is stagflation, a dangerous mix of stagnant economic growth and high inflation. This is a far more serious threat to bank stock prices than a simple rate cut. For banks, this is a nightmare. Weak growth. A stagnant economy means fewer people and businesses are taking out loans, hurting the bank's core business. High inflation. As prices rise, the cost of doing business goes up. But a weak economy means banks can't easily raise their lending rates to compensate. Credit risk. High inflation and no wage growth can lead to more loan defaults. This forces banks to set aside more money for bad debts, directly eating into their profits. While Singapore's banks are well managed and resilient, they are not immune to a global economic shock like stagflation. Section 3. Your investment plan. So, how do you invest in this uncertain environment? This is where your tiered strategy comes in. Step 1. Divide your capital. Decide on the total amount you are comfortable investing in bank stocks. Then, divide this into 3 separate tranches. Tier 1. The rate cut dip. Deploy your first tranche if the price drops by 3 to 5% after the rate cut. This is a low-risk way to get in, assuming the market has priced in the cut. Tier 2. The economic slowdown. Save your second tranche for a larger drop, perhaps a 10 to 15% decline, which could signal a broader economic slowdown. This is your chance to buy at a more significant discount. Tier 3. The black swan event. Reserve your final and largest tranche for a major crisis, a black swan event like a stagflationary recession. A 20 to 30% drop, similar to the COVID-19 crash, would be your signal to deploy this final, most impactful tranche. Step 2. Diversify your portfolio. Remember, banks are cyclical. Don't put all your eggs in one basket. Consider other sectors like REITs, which often perform well in a low interest rate environment, or companies with strong, stable earnings that are less affected by economic cycles. Step 3. Focus on dividends. The Singaporean banks are a core holding for many due to their attractive dividend yields. Even if the stock price goes down, the dividends can provide a steady passive income stream, which is the cornerstone of financial freedom. Conclusion and disclaimer: the market is unpredictable. There is no single, right, time to invest. But by using a smart, disciplined, and tiered approach, you can turn uncertainty into an opportunity. Whether it's a simple rate cut or a major economic headwind, a well-thought-out plan will give you the confidence to navigate any market. Disclaimer: this is for informational and educational purposes only and not financial advice. Please do your own research or consult a professional financial advisor before making any investment decisions. Subscribe for more bite-sized investing insights like this. Thanks for watching, and see you in the next